Hello and welcome to the channel TrustWealthy. If you want to grow your wealth in the most passive and easiest manner, then you should watch this video till the end, because I am going to tell you something which not everyone knows, and yet it is one of the most effective ways to create wealth in the stock market. Now, when people start doing investment in stock market, there are basically three things that they do. Number one, they invest in mutual funds, and mutual funds ultimately invest into the stock market. The fact of the matter is, more than 90% of the mutual funds, they are not even able to beat the average market returns. Right? Let me tell you in another way. Suppose you bought a property for 20 lakhs some time back. Now the market value of that property is 50 lakhs, but someone is paying you 40 lakhs. Will you sell it? You're still making 20 lakhs of profit because you bought at 20 and you're getting a deal for 40. However, the market price is 50. So you will not sell it, right? Because you are not getting the market price. So you have that kind of sense when you are dealing with real estate properties. Same thing happens in the stock market also. There is a term called average market returns, which is decided by the Nifty 50 returns. Nifty 50 is nothing but an index of the 50 top companies in India like Reliance, Infosys, Tata Steel, Tata Motors, HDFC, ICICI, etc. Right? So whatever is the average return of all these 50 companies is called as the market average. And as I said, 90% of the mutual funds are not even able to give the average returns of the market. They give you some returns, but it is not the average return. It's less than the average return. So you are not growing your capital effectively in the stock market if you are just doing investment through the mutual funds. Let me tell you one research done by someone. So this is a website, and in this website you can see there is a comparison between the equity mutual fund and the Nifty returns. Nifty returns, as I said, these are the average returns of the market from last 2 decades. So this red line you can see is the return from Nifty, and this blue line is the return from the equity mutual funds, the average returns. And you can see there is a huge gap between these two. So now you understand, if you invest in mutual funds, the chances are very high, like it is 90% likely that you will not get the average return of the market. Second thing that people do, like the second way to grow their wealth in stock market, so they buy and sell stocks on their own, like they invest in equities on their own. So they would have read something in the newspapers that this company is going to invest in a plant or starting a new business, or something related to a company, or they will hear it from some of the influencers on social media that okay, this company is a good investment, or some kind of tip they got from somewhere, from their friends, colleagues, whatever. So they will invest in that company, they'll wait for the price appreciation, and then they'll sell it. So a lot of people do investment in equities on their own. Now the challenge with this approach is, first of all, a lot of working professionals, they don't have time to monitor their investments as much as it is required. You cannot buy an equity and then leave it forever. You have to continuously monitor the progress, what is happening in the company. You need to be aware of the things, because unless you are aware of what's happening in the company, you should never ever invest in that company. Right? We all know what happened to the case of Yes Bank, DHFL, and there are so many other stories in stock market where people have lost huge amount of money. Right? And not just that, ultimately what happens, more than 99% of the investors, they will make money in one share but they lose in the others. And this keeps on happening. Ultimately at the end of the year, if they look at their portfolio value, they will not see a lot of improvement in that. Like they will not see returns in that. In fact, more than 90% investors, they lose money if they invest in equities on their own. Overall, they may make money in one equity, but they will lose money in the other equities. So they'll make 10 rupees, let's say, in one share, but they will lose more than 10 rupees in the other shares. So ultimately it becomes a loss making game for them. And the third way people do investment in stock market is by uh, derivatives trading. So they indulge in options trading, futures, and they learn few strategies, few techniques from a lot of trainers, social media influencers, and all. However, this derivatives trading is a very nuanced way to make money in market. It requires a lot of skills and a lot of experience also, which many working professionals may not afford to have because they are already occupied in a full-time job, or if you are doing a business, then you are also taking care of your business, so you cannot pay that much attention to the learning the tricks of the trade. So there are basically three ways that people grow their wealth in the stock market: mutual funds, uh, investing in equities on their own, and third, doing derivatives trading. And I have mentioned the pros and cons of each of them. Now I will come to a fourth way to make money, which is way easier than all of this. You will not have any challenges than that whatever you have heard from me in all these three approaches. And that is what is the gold mine of today's video. So how you can create your wealth in stock market in the easiest and the most passive manner. Let me tell you, you can do that by investing in the Nifty 50 ETF, which is called Nifty Bees. Right? Let me show you how it looks like. So this is Nifty Bees. You just type in your broker window NIFTYBEES and you will see this Nifty Bees ETF. And ETF is nothing but it's a short name for exchange traded fund, and this ETF basically tracks the Nifty 50 stocks. As I said, Nifty 50 is basically a stock of, it's an index of 50 top companies in India, right? And these companies are super solid, super strong. They are not going to fail anytime soon. They are very strong companies. So whatever is the average return of all of these 50 companies, like the average return of Nifty, that itself is tracked by this Nifty Bees. So if you invest in Nifty Bees, it essentially means that you are getting the average returns of the Nifty 50. So you're basically investing in the top 50 companies of India. So whatever is the average return from the market, like whatever is the average Nifty 50 return, you will get very close return to that if you invest just in Nifty Bees. That's it. So if Nifty 50 average return is, let's say, 10%, Nifty Bees may be 9.9% or 10.1% or 10.05, 9.95, like that. But it will closely track the Nifty 50 index. And in the long run, Nifty 50 has always gone up. There may be slight disturbances, but again it has gone up. Now there are several advantages. Number one, you don't have to track an individual company, like what is happening in that company, because you are investing in the ETF. So that worry is gone. Second, you are not worried about learning about the derivatives trading, because it has nothing to do with the derivatives. And third, you can be assured that your money is safe because you are investing in the top 50 companies of India. And you can also understand, like maybe one of those companies may not perform, but the rest 49 or 48 will definitely perform, correct? Because they are the top 50 companies. So that way it is a very safe way and very passive way to invest. Now when you should invest? So in the next video, I will come up with a specific indicators, a specific time when you should put your lump sum amount in this Nifty Bees, right? This video, if I include that in this video, it will become pretty long. But to give you an hint, you should invest lump sum amount in this Nifty Bees when you see a big fall in the market, because that's when you get a cheaper price. It's always good to buy it cheap and hold it. So you don't have to sell Nifty Bees unless there is a urgent requirement in your home, if there is an emergency. You can simply buy whenever there is a big dip in the market. Let's say Nifty has gone down by 1% in one day or 2% in one day, something like that. Simply deploy your capital in Nifty Bs, purchase it, hold it in your demat account, and just simply wait for the price appreciation. That's all. That's what you have to do. Nothing else is required to be done from your side. You continue to do your business, continue to focus on your job, and your wealth will keep on growing, and it will keep on with the average pace of the market. Better returns than the mutual funds. So I hope you like this video, and that's all in this video I wanted to cover. And in the next video I will talk about the specific indicator using which you can even time the market even little more. So thanks for watching, stay tuned, and if you have not yet subscribed to our channel, please do subscribe. And if you need any further help from our side, please write to us at connect@trustwealthy.in. Thanks for watching, have a nice day.